Prepare for a storm on the horizon. A recession is looming over the United States, and Europe will soon follow suit. This unsettling prediction comes from HSBC Asset Management. They sound the alarm, declaring that recession warnings are flashing red for many economies while fiscal and monetary policies fall out of sync with the volatile stock and bond markets. As we brace ourselves for the economic turbulence that lies ahead, we are left wondering, how will this impending recession impact our lives? Can we weather the storm that is about to unleash its fury upon us? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button, leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. HSBC Asset Management has issued a chilling warning that the United States is on the verge of a recession, with Europe expected to suffer a similar fate in 2024. In their mid-year outlook, the esteemed British banking giant's asset manager cautions that recession indicators are at an alarming level for numerous economies, while the policies governing fiscal and monetary matters no longer align with the unpredictable fluctuations of the stock and bond market. Joseph Little, the global chief strategist at HSBC Asset Management, acknowledges that certain segments of the economy have displayed resilience thus far. However, he points out that the risks are tilted heavily towards a high probability of a recession, with Europe trailing behind the United States, although the macro trajectory is generally in alignment. As Little states, we are already in a mild profit recession, and corporate defaults have started to creep up too. In the face of these distressing prospects, there is a glimmer of hope. HSBC Asset Management anticipates that the persistently high inflation rates will eventually moderate, providing policymakers with an opportunity to implement interest rate cuts. Despite the seemingly hawkish stance adopted by central bankers and the lingering grip of inflation, particularly at its core level, HSBC Asset Management foresees the U.S. Federal Reserve cutting interest rates before the conclusion of 2023. Following suit, the European Central Bank and the Bank of England are expected to follow suit in the subsequent year. HSBC Asset Management acknowledges that the ability of central banks to reduce rates will be contingent upon inflation remaining close to target levels, a challenge faced by many major economies. It is therefore crucial that the recession does not materialize too early and exacerbate disinflationary pressures. Little emphasizes, the coming recession scenario will be more like the early 1990s recession, with our central scenario being a 1-2% drawdown in GDP. The impact of the anticipated recession on Western economies will create a tumultuous and uncertain market outlook for two primary reasons. Firstly, there is the rapid tightening of financial conditions that has triggered a downturn in the credit cycle. Secondly, markets currently fail to reflect a particularly pessimistic view of the world. As Little cautions, we think the incoming news flow over the next 6 months could be tough to digest for a market that's pricing a soft landing. HSBC Asset Management asserts that this forthcoming recession will not be sufficient to eradicate all inflationary pressures, leading to a prolonged period of somewhat higher inflation and interest rates in developed economies. Consequently, a cautious approach to risk and cyclicality is recommended for portfolios. Interest rate exposure, particularly in the Treasury curve's front end and mid part, is considered appealing. The firm also identifies some value in European bonds. However, caution is advised regarding developed market stocks. Looking towards Asia, HSBC Asset Management places significant trust in China's recovery from the stringent COVID-19 lockdown measures. The bank believes that high levels of domestic household savings will continue to bolster domestic demand, while the challenges faced by the property sector are reaching their nadir and government fiscal initiatives are generating employment opportunities. Little emphasizes that the diversification of Chinese equities should not be underestimated, noting that value is outperforming growth in China and Asia, which stands in contrast to developed stock markets. India, too, garners attention from HSBC Asset Management as it emerges as the primary macro growth story in 2023. The Indian economy has made a strong recovery from the pandemic, propelled by resurgent consumer spending and a robust services sector. Little highlights the favorable economic conditions, stating, improved corporate and bank balance sheets have also been boosted by government subsidies. All the while, the structural, long-run investment story for India remains intact. As we digest the implications of these unsettling predictions, we must confront the reality of an impending economic storm. How will you navigate the choppy waters of this approaching recession? Will you fortify your portfolios with interest rate exposure and cautious risk management, or will you seek refuge in the diversification of Chinese equities? Share your opinions on how to weather this storm and build resilience amidst economic turbulence. Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.